Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the markets, key events and trading opportunities. Also, I'll just let you have a look at the couple of disclaimers. Hopefully you can see those. I'm just checking what you can see actually, and it doesn't look as though you can see what I'm looking at. So hopefully that should rectify itself very soon. You should be looking at the risk disclaimers that I need to show you, and there are a couple of those. Otherwise, I'll just talk about some of the key objectives of the webinar. Markets we think are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories and narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. Our goal as well is to break down all the market jargon and complexities that we all read about. So if you do have any questions, please do ask them along the way, and I'll hope to answer them as we go, or at least by the end of the webinar. And I can see those in the box, hopefully, that you can see where you can write any questions you do have. If you have anything about what we're talking about some of the trade setups that you're looking at, some of the fundamentals that you're reading about as well, please do ask any questions along the way, however big, however small. Okay, it's Wednesday, August 9th. It's just after 11 a.m. in London here. So let's just check out how markets are shaping it currently. European bourses, well, they're looking to claw back lost ground after the Italian government tried to cushion the surprise windfall tax announcements that it made yesterday. Asian stocks are pretty mixed, while stateside futures, that's US stock futures, are trading on the front foot, trying to make back some of those losses from yesterday. In the FX space, the DXY, so that's the dollar, really is waning slightly back under 102.50. But price action across really all the G10 currencies remains relatively range bound. In quiet summer trade, really, it has to be said. The one is in focus of the Chinese currency, in focus overnight after the Chinese inflation data kind of underscored weak domestic demand, with the expected post-COVID rebound in consumer spending still failing to materialize. The Aussie and the Kiwi actually modest outperformance, really following quite a few sessions of hefty losses in the Antipodean dollar currencies there. Mild rebound in commodities and a slightly better risk mood, so helping those cyclical high beta currencies that we like to call them here. Just let me just pull up the first chart which we'll look at. We'll look at firstly stocks and some of the US indices, some of the earnings as well, the big mega cap tech earnings out last week. We'll just run through those, and then some of the technicals in the major US stock indices. Then we'll move on to actually last week's main data. It was packed full of really big risk events. So we'll look at Eurozone CPI data, inflation data, that is, how that's impacting euro dollar, and look at the charts there. Then we'll turn to the US. A lot of news events really out last week. Fitch cutting the US credit rating, just touch upon that before looking at some of the ISM manufacturing services numbers. And then of course Friday's kind of mixed US non-farm payroll report. We'll then, after all of that, look at the two central bank meetings from last week. So that's the Bank of England and the RBA, as well as looking at cables. That's sterling against the dollar, and the Aussie against the dollar as well, whilst looking at the RBA, as I say. Before then, the main event of this week is tomorrow's US inflation report, of course, and we'll give you a preview of that, and all as well looking at some sort of graphics and charts to help sort of check out the main themes in that. Okay, just bear with me 1 second. I'll just pull up first of all a chart which hopefully you guys can see here. I'm just checking, and I'd like to double check that you can see what I'm looking at, because for some reason It's saying you guys can't see what I'm looking at, but hopefully if I don't get anybody telling me otherwise, then it is all good and you can see this chart, which I can see at the moment, which is the the NASDAQ weekly chart. But I'll just pull up now the S&P 500 weekly chart that we'll get to shortly. But generally in stocks, well, generally global markets have been relatively cautious this week after that US credit downgrade that I mentioned, coupled with as well US Treasury's announcement that it will be increasing its bond issuance in the coming months. And that really propelled US Treasury yields higher last week. The US 10-year Treasury yield, that is kind of seen as a global proxy for borrowing rates across the globe, really, as I say, that sort of pushed above 4%, and whilst the 2-year yield, the Treasury yield, which kind of tracks Fed funds, that's been tracking sideways and just pushed lower actually end of last week after the non-farm payroll. It's really the 10-year Treasury that's been getting the attention because of pushing above that key psychological 4% level. This really helped the dollar, of course, through the sort of interest rate channel. Higher yields helps the dollar, of course, and the greenback also attracted some safe haven flows as well as riskier assets. Stock markets really suffered from this spike that we saw in yields. Moving on to this week, then we've seen a sort of plunge in Chinese exports reported earlier in the week, and then that was followed by the widely anticipated fall into deflationary territory overnight. So we saw June China CPI contracted by 0.3%, and then PPI, that's producer prices index, so that's the sort of upstream prices, that failed to ease back substantially as well. So it's the first time actually since the pandemic peak that both CPI, consumer price index, and PPI have contracted. And really it's evidence of combined consumer and producer price deflation, undoubtedly endorsing the notion of this broad-based economic slowdown really in China, which is a theme to think about probably over the medium term. In the near term, really this sort of China growth re-rating kind of has been out there for a while, I'm sure you know, and there's kind of slightly less spillover in this morning's markets, at least. As I said, there's a mild boost to some of those higher beta positions in FX, for example, and stocks are doing slightly better, sort of unwinding yesterday's risk-off session. Concerning stocks in the earnings season, we're mostly through now. We've had most of the 500 companies that make up the S&P 500 already through their second quarter earnings reporting season, and slightly more than normal have reported per share profit that beat Wall Street's estimates. That's according to FactSet. But for the third quarter, it's slightly different. And analysts now expect a mere 0.2% increase in per share profit growth overall. That was according to FactSet on Friday, and slightly lower than the 0.4% growth that was expected for the third quarter on June 30th. And bear in mind, we still have 2 months still left in the third quarter. That forecast then is likely to come down as the period progresses, which means really Wall Street's profit expectations are getting ever closer to turning negative. Again, something to bear in mind probably over the medium term for you guys, and we're certainly thinking about that as well. Closer to home then, as I mentioned, the major tech companies have reported earnings over the last 2 weeks. Now the earnings calendar kind of starting to thin out. Concerning last week's main earnings events, that was Amazon and Apple, kind of contrasting fortunes really, especially in the stock performance. Apple's earnings, record services growth, but slower iPhone sales is essentially the one-line summary. It did deliver a beat both on top line and bottom line revenues, but the market's really focused on those iPhone sales slowing. The stock actually sunk 4.8% on the day. That was its biggest one-day drop since late September. Whereas Amazon on the same day after the close on Thursday, that was last week, they topped analyst estimates And the company also delivered upbeat guidance, really key upbeat guidance for the third quarter, as growth in its cloud business topped estimates. So markets really rewarded Amazon. The stock was up 8.2%, 8.3% really, after trading actually up around 10% immediately afterwards in the post market. But the 8.3, 8.27% increase on the day, biggest one-day jump since November. Really key, these two companies, of course, because they account for almost 20% of the Nasdaq's market cap. And that's why it's worthy of some attention. Otherwise, for indices, well, we had a small trading range this week after Wall Street really notched their longest daily losing streak in 3 months last week. Stock markets closed on Friday. Mixed session after the non-farm payroll, of course, then the weaker than expected US jobs growth, plus those earnings, as I said, mixed earnings again. And the S&P actually shed 2.3% for the week, while the Nasdaq, so the tech-focused Nasdaq, that fell 2.8% across the 5 sessions last week. So those two indices, they had their 4th consecutive session of declines. You can see on here, which is the longest losing streak since early May. And then previous to that, because obviously we only speak to you every 2 weeks, then previous to that, the S&P actually notched a 3.1% rise in July for its longest monthly winning streak in 2 years. So really interesting here. You've got the weekly chart, as you can see, nice bullish channel really from those March lows, really from back, well, in December, of course, and back to the lows actually below 3,500 back in October. But we've got this bullish channel here, ascending bull channel, so a series of higher lows, higher highs, really nice channel. And from the sort of March low around 3,800, we've pushed up obviously a few weeks ago to a high of 4,600, just above there. That is a bull market in terms of being up over 20%, so really interesting. But then we've had this pullback, of course, and last week, as I mentioned, quite a correction really to rising prices. We're not sort of at the bottom end of that channel that you can see, so still looks as though we're in bull market territory really, potentially. You can see the RSI on the weekly sort of touched above overbought or into overbought territory, but then quite a healthy pullback really, as long as we can stay around here. We have just pushed below, just bear with me 1 second. Yeah, we've just pushed below a sort of minor fib level. So next support really probably, well, last week's low would be key, initial support, which is around 44.74. We did get below that earlier this week, 44.64, but that looks an area of initial support. Otherwise, the sort of bottom of this trend channel, which is sort of 44.220 or so. If we look at the daily, you can see that really nice channel, a series of higher lows, higher highs, and then pushing up towards 4,600 and just this correction. As I say, well, on the daily chart, you can see this blue line, which is the 50-day moving average. A lot of people look at that. That's a 44.21, so just at the bottom of that trend channel. So should be some nice support there. Otherwise, then you've got a fib level just above 4,300, and then these other lines were way above the 100-day moving average. That's the grey line, and the 200-day moving average down way below at 4,100, 4,104 there. For the Nasdaq, let's just check again. Again, on the weekly, you can see this really nice bull channel. We pushed up again, up above a swing high that we've been pointing out actually over the last few months. Back in late March 2022, that was at 15,265, and we're just hanging above there now. And sort of, we did peak out of that uptrend channel, but we're sort of hanging on to it at the moment. So interesting sort of levels of confluence of support really, as well as then that 50-day moving average, that's at 15,103 as well. So Nasdaq critical, well, critical, interesting levels, should we say, at the bottom of the recent up channel there, that bull channel. So will be interesting to see how prices react to this. Should be some sort of support. Just watch out for that. And then that 50-day moving average at 15,103. Just on the Dow, we like to point out, well, we've got a couple of swing highs. We've got one in at 35,314. We tapped above that a couple of times in the last couple of weeks, but haven't managed to close above it. You can see that dotted line there, and we're just sort of tracking sideways, really. Yeah, just sort of consolidating this nice break above. Let me just go back to the 34,281. We'd highlighted that over the last few months. Couldn't quite break above it over a number of occasions, and then tapped it in sort of end of June, start of July, and then pushed above it. And the more you track sideways, then the bigger the breakout should be, and that was really strong. You can see middle of July, and then we're up to now this swing sort of high from back in when April 2022 at so that's probably first level of resistance, 35,492, just tracking sideways really, and we'll just watch as though we can keep these gains. Initial support probably will be near term at 34,712, probably that little peak there. Otherwise we go back to sort of 34,281. Okay, that's the Dow and those US indices. Let's move on now to the Eurozone. Eurozone inflation numbers. They are from last week, of course. Hopefully you can see this, which is a chart really showing last Monday's now set of data releases in the Eurozone showed really growth and, well, we had two sets of numbers, growth, GDP and inflation, kind of moving in divergent directions. So the Euro area grew slightly more than expected, 0.6% year on year. That was 0.3% quarter on quarter. In the second quarter, that was against 0.2 Q on Q and 0.5 year on year. So slightly better readings there after the economy, of course, stagnated in the first quarter. More important probably for us, for policymakers at the ECB, certainly inflation numbers. Headline inflation slowed in line with consensus from 5.5 to 5.3% in July. The month-on-month figure now in negative territory as it came in at negative 0.1% for July from 0.3% in June. And then core inflation topped estimates to come in firm and unchanged on the annual basis at 5.5%. So you can see that in the blue line falling, of course, and then the core remaining pretty much unchanged. Most interesting dynamic probably in these numbers, and one that the ECB will likely follow, is related to services price pressures. While goods inflation continues to ease, it's really about services price pressure, which have kept on mounting in line with wage growth and stronger demand. All of this means, what's it mean? Well, these figures leave the door open, of course, to another hike by the ECB before the end of the year and even in September. Markets really, they're kind of reluctant to endorse this scenario slightly. They're only pricing around 15, 16, 17 basis points of tightening by December, so slightly less than the 25 we'd see for a rate hike, of course. And certainly markets kind of taking away that dovish message that we saw from the ECB the previous week. Certainly it'd be good to hear more hawkishness probably from ECB members before aligning with that core inflation data, certainly, and then fully pricing in another hike. August, we should remind you, is a quiet month actually for speakers, ECB speakers. And also, despite growth holding up for now, there are concerns, of course, around the activity levels. So that's economic data in Germany and Italy is shrinking. And then we also need to think about sort of bank lending. We've had some of those surveys out from the ECB, which are showing tightening. And for now, the ECB, well, whether they pause possibly in September or not, markets slightly erring on the side of another hike. Let's just go to euro dollar then, which, let me just pull up the chart. Just bear with me 1 second. Yeah, here's the euro-dollar chart, which you can see nicely here. I think it's interesting, actually, if we go to the weekly, we can see, let me just expand that. Yeah, just sort of looking at another correction really in euro dollar. We've had sort of 3 significant corrections this year. You can see there, first correction in February, then one in May. The February one was worth around just under 5%. The May one worth just over 4%. This current correction just above 3% now. And these have really come on the back of heavy one-way positioning. A lot of you might not look at this, but given that most expect euro dollar to be higher by year end, so the current consensus is around year end level of around 112. Then there's been a lot of positioning for that, and when that sort of fails to happen, then long scramble for their positions. We would warn then kind of getting too pessimistic on euro dollar, because as we've mentioned, the ECB is still probably going to tighten at least once more. Core inflation, as we've highlighted there, is still too high, and really their markets are still considering the September meeting as live for a 25 basis point rate hike. That should underpin really support for euro dollar. If we just go to the daily chart and just stretch this out a bit, then yeah, interesting. We have this convergence now between or of the 50-day moving average and the 100-day moving average around sort of 109.25, 109.30 area. So those should really offer some support to this major. We've got resistance probably above. I've still got this dotted line in here from the February high, which we couldn't break above. You can see in April and May, we did obviously push nicely above it sort of mid-July, but then back to it. So really could also, offer initial resistance. That's a 110.32 before then pushing up towards 111. Otherwise, as I mentioned, support zone, strong support zone around 109 sort of 30, 109.25. Okay, that's euro dollar. Let's move on to the US now, and we'll look at the DXY first of all, actually, which is kind of the mirror opposite, if you like, of euro dollar. If you think about the DXY is the index which tracks 6 of the US's major trading partners, with the euro being by far the biggest weighting in the DXY, around 56-57%. So if you turn this chart on its head, it kind of maps the euro dollar chart, and you can see again the 50-day and the 100-day moving average there converging. On the DXY, it's around sort of 102.30. You can see actually now exactly the same, those two moving averages. So possibly interesting. We're sort of trading above that at the moment. So whether that's support, resistance, is something to take note of. We've got resistance above, otherwise just below 103, around 102, sort of 80, 102.85, and then probably for us is 101.74 as initial support, probably just above that if you're trading shorter time frames. Just want to touch then on, first of all, that Fitch credit rating downgrade. They downgraded the credit rating, to AA+ from AAA. They cited repeated debt limit standoffs, expected fiscal deterioration over the next 3 years, and little progress in tackling rising Social Security and Medicare costs. Certainly those last-minute deals that we've seen recently have sort of eroded confidence in fiscal management. It's kind of hard to argue with that. But then sort of Janet Yellen, Treasury Secretary Yellen, that is, criticized the decision as arbitrary and outdated. And then we had other US officials really saying that amid strong growth, it left no doubt about the US's ability to service its debt. Just recall that S&P Global, they cut its US debt rating in 2011, way back. So it kind of only leaves now Moody's among the major rating agencies that still rates the US as a top credit. At the margin, didn't really affect markets near term anyway, but possibly it could add to sort of structural headwinds for the dollar in the medium longer run, and kind of may add to investor concerns about sort of de-dollarization trends, if you like. So those trends are coming out of the dollar, diversifying into other major currencies, as really central bank reserve managers kind of try and reduce their exposure to the greenback. That's probably longer term. Otherwise, near term didn't have too much of an effect. We then had the ISM data, quite important, this manufacturing and services. Manufacturing missed expectations. Again, really 46.4, I think, expected 46.8, so really quite depressed and well below that 50 sort of boom bust level that we like to pay attention to. Just looking through the report, employment saw a steep fall, deeper than expected, and that kind of shows signs of possibly a loosening labour market. Certainly in the manufacturing sector. The services data that came out a couple of days later, that kind of sends possible stagflation warnings. So that's where we get lower growth and sort of still elevated inflation. The services it remained in expansionary territory, should say, for the 7th straight month. So, but it did fall to 52.7 from 53.9, and it was short of the expected 53.0. But details did look disappointing. Business activity, new orders fell, employment declined, but then the inflationary gauge of prices paid actually lifted. It was actually its biggest 1 month jump since August 2021 and first increase since October last year, barring the negligible rise in April this year. So just something to be mindful of. Again, really good sort of forward-looking data this, and just sort of worth highlighting. Otherwise, we had, of course, just we've sort of run through the DXY. Actually, I'll just run and have a look at for you the next chart that we have, which is obviously a review of non-farm payrolls figures. Hopefully you can see this graphic here, which has all the important data that was released on Friday. Headline jobs obviously came in at 187 in July. That missed the 200K estimate. Was just above last month's 185K, which was revised lower from 209. Private payrolls, they jumped, while government payrolls were responsible for a much smaller 15,000 jobs in July versus quite a high 57,000 in June. Elsewhere, the unemployment rate, the jobless rate, that moved lower. Really interesting. So kind of this is why it was seen as a mixed report. So lower headline figures, but lower jobless rate, higher earnings, which sort of says the labour market is still relatively hot. So yeah, jobless rate dropped to 3.5% and 3.6%. Remember, the multi-decade low is at 3.4%, so we're still nowhere above that at all. And then wage growth, that was pretty hot as well, rising 0.4%, expected 0.3%. And then the year-on-year number as well, 4.4, previously 4.4, but was expected to tick 0.2 lower to 4.2. Kind of this report, yeah, it keeps the market reluctant to price in another Fed rate hike. As I've got here, around a 69% chance that rates stay at the current target range of 5.25% to 5.5% by November. That is, it's 80-20, then 80% chance markets give rates stay at that level in September. Interesting, we've had some Fed members on the wires, sort of mixed views again. Michelle Baumann over the weekend sort of was slightly more hawkish, warning that more rate hikes will likely be needed. But then we've had Bostic and Goolsbee saying after actually the slower jobs growth data that the labour market is becoming better balanced, so the FOMC can be more patient. Okay, that's the US numbers really, and we looked at the DXY as well. Just bear with me 1 second while I just pull up then. Well, first of all, actually, I'll just show you that pricing then. So markets sort of, we're towards now peak rates 5.25% to 5.5%, and then markets now still pricing in rate cuts through to the end of next year. Just be mindful that Chair Powell really has sort of tried to rein in that rate cut talk, and whether we get any of that going forward will be interesting for this pricing. Okay, next let's look at the Bank of England here. You can see again similar charts just showing interest rates and where they're expected to go. Remember, the Bank of England decided to raise rates by 25 basis points, taking the base rate to 5.25%. Matching consensus expectations, really. There were 3 dissenters, 2 of whom voted for a 50 basis point increase, and then 1 voted for no change at all. The MPC, they said current policy is restrictive, which hints we could be near to the top 4 rates, but then they left the door open for further action if inflation persisted, and really emphasized that rates may have to stay higher for longer. The bank then retained its forward guidance that said it could hike again, just sort of quoting them, if evidence of more persistent pressure show up in the inflation figures. This is the same phrase really that they've used all year, and it's sufficiently vague to keep various options on the table open for September and beyond. It was a Super Thursday, so Governor Bailey had the MPR projections, that is monetary policy projections. As I say, they reduced the growth forecast for the next 2 years, and then the inflation forecasts were at target in a couple of years' time, suggesting that the economic path will likely remain quite tough to navigate. And Bailey certainly mentioned that quite a few times at his press conference after the announcement of the rate hike. Interesting, the bank's forecast as well, they point to sub-target inflation, have been doing for some time now, whilst the case under the assumption, well, curiously as well, the case under the assumption that bank rates stay unchanged at its new level over the coming months. And you can see markets really thinking, and also policymakers as well, have outlined that they don't have that much faith in some of these models that they have been using. So kind of interesting, that those sort of comments, but just bear that in mind as well. Markets wise, otherwise, really interesting actually. Now we've had sort of quite a stable and unusual period, really, of very stable Bank of England rate expectations over the last few weeks, certainly since the meeting as well, with really an anchoring of the prospect of a peak rate around 5.7 to 5.75%. I think we've just come below actually now the 5.7%, 75%, as I say, but that's 2 more rate hikes, 2 more 25 basis point rate hikes, that is, by March next year. And you can see that peak just above there, and then we fall back as the market prices in rate cuts. Interesting for, well, trade weighted sterling. That's only marginally weaker actually since the hike last Thursday, but now with these sort of stable rate expectations, that anchoring of the prospect of a peak around the sort of 5.75 area, then possibly we get more of a range bound pound over the next few months, possibly. There's not much on the UK calendar, certainly near term, before we get Friday's release of Q2 GDP numbers. I suppose a soft outturn in the growth data could see markets scale back expectations of an expected additional 25 basis point hike after September, say. I think consensus market has sort of 5.7, 5.75%. I think consensus just above, probably 5.5%, I'd say. Okay, interesting as well. I did see this chart as well. It's just going back across the last 100 years or so, actually, quite an interesting chart we thought to put in, and you can see that the rate has averaged 5.25% over the last 100 years, really. So we've had big spikes, as you can see, the 70s oil crisis, 80s boom, into double figures. Then the benchmark rate was in the UK, but then obviously we've had this period of sort of zero interest rates from the GFC onwards, up until now, this sharp spike higher to 5.25%, which is the average over the past century or so. So interesting chart we thought to put in there for you. Okay, let's just go to cable. So that's sterling against the dollar. Just bear with me 1 second, which is here. Yes, fortunately now it's updating. You can see all of what I'm seeing, and hopefully you have now as well. You should be seeing a cable chart very soon. And just bear with me 1 second. For some reason it's not showing. There it is, right. Just takes a little bit of a delay. Yeah, so cable, as I say, sort of yeah, been well, relatively range bound. You can see we did dip below last week down to 126.20, but then quite a bullish candle in some ways that we closed well off those lows. Let's just highlight that candle, well off those lows, quite a bullish sort of candlestick pattern there, closed well off the lows, and then a positive day the following day after that previous day of selling. Just near term then, well, first of all, what are we looking at? We've got the 50-day moving average of 127.56. We're just below that at the moment. And then we've got this long-term trend line sort of support was and now possible resistance. That's just above, probably at around, where are we? Around 128.26, probably tallies with that fib level, which we've drawn in here. The fib level being those levels of the March rally, and the first one sort of around 128.26. That would be upside resistance, if you like, if we do get above these near-term highs, which are sort of 127.86, 127.90. Then the first level, yeah, above that 128.26, and then possibly then 128.48, which is these highs from mid-June. Otherwise, support, initial support looks like it's going to be around 126.84, yeah, 126.82, and then below that, that fib level 126.30, just about tallies with that spike low at 126.20. So that's cable, but could be range bound, as I say, over the next few weeks at least, with this anchoring of the peak rate. But keep your eyes on the Q2 GDP numbers out of the UK on Friday. Okay, next up, just quickly, is the RBA decision as well from last week. They kept rates on hold. Last Tuesday, what that was at 4.1%, defying consensus expectations, actually. The decision surprised the average analyst who expected 25 basis points, but not so much markets. They only saw markets only priced in a 20% chance of another tightening move. So that was interesting divergence there. But the RBA kind of opted for a pause to better assess incoming data, basically. And a hold decision kind of comes amid uncertainty, really, of this pass through the previous 400 basis points of rate hikes that we've seen, and those effects then on the wider economy, of course, the labour market and household consumption. Really, you could say that is an issue for all central banks, actually, with such aggressive tightening over the last 18 months or so. For the RBA, then, a tight labour market is showing further signs of some easing, and inflation is declining, but it's still too high. And certainly persistent services inflation, again, like we mentioned with ECB, that is still a point of worry. Wages continue to grow as well, and so really the RBA did keep the possibility of more tightening on the table, and really it depends on how the data evolves ahead of its next meeting at the start of September. I think that's September the 5th. I think it's interesting, money markets, they currently attach probably just below now a 50-50 chance of one more rate hike this year, which would take rates to 4.35%, possibly, we think, slight risk of that some underpricing there, really, and certainly with another higher inflation read, potentially due to electricity tariffs in September, that really could convince the RBA to add a hike before the peak. That's worth looking out for, because then certainly that could pave the way for the Aussie to rebound. It has suffered quite a lot recently, really been hit by the negative implications of Chinese growth, that re-rating, and then as well, of course, recent poor global sentiment. And you can see this is the Aussie dollar chart. We've kept in this sort of range bound trades just below 66 up to the highs around 68. Obviously we've poked above it, but then not lasted very long and sort of reverted back after a few days. Interesting, now we're just below that sort of lower bound really of that recent range going back to March. You can see there we did poke lower yesterday. That looked really bearish, 64.96, but then closed lower, but nowhere near those lows. So it'll be interesting. Yeah, that's the first marker for us, 60, just around 65, and then obviously this cycle low at 64.58 will be really key for any more downside. Otherwise, potentially, depending on US CPI, of course, tomorrow, then yeah, just watch out whether there's a support or resistance now to a move higher or a move down towards 65. That is Aussie dollar. Right, just finally moving on to the main event of this week, which is the US CPI data, of course, tomorrow. I've just noticed this should be a preview, actually. I wish it was a review and we knew the numbers and we could trade off that, but no, this is a preview of tomorrow's US CPI data. Let me just check. You can see that, or we'll be able to see that very soon. So it's a graphic with essentially all the well, the three main numbers that we look at, most economists will look at for the US CPI data. Yes, consensus looks for consumer prices to rise 0.2% month on month in July. The previous was 0.2%, and then that actually sees the annual rate ticking up to 3.2% year on year from 3%. The rise in this annual headline inflation is likely going to be driven by unfavorable base effects. So that basically means it reflects falling energy costs from last summer. They then drop out of the annual comparison. That's what we mean by base effects. And that means those falling, very sharp falls drop out. So we may see a little uptick. And then we also have modestly higher gas prices as well. But that said, services inflation, which is key for policymakers, again, that should continue to decline. And just on the core rates then, the annual core should remain unchanged at 4.8%. And then the monthly core rate, which is key really for us, for policymakers, again, at the Fed, that should continue to rise, but only at 0.2%. And many economists think 0.2% number around that figure is what is needed over quite a few months, a series of months, to bring down inflation back to 2%, the target, of course, of the Fed. So certainly if we get a 0.2 number, that will be encouraging and maybe sort of trump the slight uptick in the headline rate, because that is known that it will be expected to increase due to those unfavorable, those negative base effects. Just in detail then, ex-shelter or shelter inflation, really that gets some attention. That now appears to be easing with the expected 12-month lag from measures of new rents and house prices hitting CPI. If then we look at ex-shelter, that's services inflation, that's seen at plus 0.3% month on month. But used auto prices are also seen falling for a second straight month. And that typically leads into used autos feeding into CPI by a couple of months as well. So the bottom line really is that a reading in line with expectations would represent the second, as I said, consecutive month that monthly core inflation has broadly been in line with the Fed's target. Again, that is what's needed to bring their 2% target back into range, of course. And after this print, CPI inflation is likely to look increasingly encouraging for the Fed as well, with these shelter costs impacting, but something to be wary of. And I know some economists are highlighting this certainly is obviously the increase in Brent crude prices and just the uptick in some of the commodity prices as well to be wary of. Also to note certainly is this is the first of 2 CPI releases ahead of the 20th of September FOMC meeting. So we might not get a major reaction unless we get an outsized sort of data print, because the more timely release is just a week before that Fed meeting on September 13. And here you can just see the chart, right? You can see the headline, you can see the headline in the orange, which has fallen sharply, of course, from 9.1% back in the middle of 2022. And then the blue line is obviously core, so that strips out volatile food and energy costs. And that is now declining, which is encouraging. And then the month-on-month figure will be key, we think, for the Fed going forward. Okay, that is all we have time for today. I don't see any questions, not yet. So hopefully that's been clear and of some use to you guys. It's really good to have all of you on the call still and staying the duration of the 40+ minutes. Yeah, watch out for the US CPI data, of course, and we'll speak to you in a couple of weeks. Okay, take care out there.